Okay, so we are going to take a look at the accounting equation, kind of do a little review of the accounting equation, and go over how different business transactions affect the accounting equation. So to begin, let's take a look. The accounting equation is assets equals liability plus stockholders' equity. So last year, you knew stockholders' equity as owner's equity. Okay, it is the same thing, except owner's equity is the account that's used when we're dealing with sole proprietorships, and stockholders' equity is the account that's used when we are dealing with corporations. And remember, this is the owner's stake in the company. Okay, so when you have corporations, there are stocks that the owner can buy, and that is how they show their ownership in the company. They own different pieces or various amounts of stock. Okay? So if we recall, all business transactions can be stated in terms of changes in the elements of the accounting equation. All right, let's start our very first transaction. On November 1st, 2011, Chris Clark deposited $25,000 in a bank account in the name of Net Solutions in return for shares of stock in the corporation. So remember, it's just like making an investment of money, except this time when the owner of the company makes an investment in cash, they get stock back. They get actual pieces of stock, all right? So when analyzing transactions, remember the first question we ask is cash changing hands? And if it is, then you know that that is one of the accounts, okay? And here we know $25,000 in a bank account in the name of the business. So we're going to write cash of $25,000, okay? Now, there's no longer owner's equity. It's referred to as stockholders' equity. And he's receiving what is called stock. And so this is going to show up on the other side of the equation as capital stock. You can't see my T there. That is your capital stock. Okay, so that is transaction A. Transaction B. On November 11th, Net Solutions paid $20,000 for the purchase of land as a future building site. So is cash changing hands? Yes. Okay, so we know one of the accounts is going to be cash. And what are we getting in exchange for the cash? We're getting land. So the other account is going to be land. Okay, so this transaction will look like this. Minus $20,000 cash plus, and we're going to add an account called land, and that's going to be a plus $20,000. Okay? And then we need to update our balance like we do after each transaction. Right? That's why I have this box over here for us. And we bring this down. So we spent $20,000 in cash, but we got $20,000 in land, and our capital stock remains unchanged. Okay? All right, transaction C. On November 10th, Net Solutions purchased supplies for $1,350 and agreed to pay the supplier in the near future. Okay, so is cash changing hands? No. Okay. Are we getting something? Yes. What are we getting? We're getting supplies. So we're going to put supplies. It's an asset of $1,350. Show the plus sign. And when we buy something on account, paying later, so we write purchase on account, you will recall there is an account called accounts payable. Okay, this is a liability, something that we're going to have to pay back in the future. We're liable to pay for it. Okay, and that's going to be $1,350. for $13.50. So when we do our updated balances, we just carry numbers down, carry supplies down, put a plus in there, plus, and then we have $13.50 plus what's already there in capital stock. Okay? So purchase on account, accounts payable. All right, transaction D. On November 18th, 2011, Net Solutions received a cash payment of $7,500, I should say payment, of $7,500 for providing services to its customers. Okay? So services, if you recall, should trigger in your brain revenue. Okay? But when we're dealing with a corporation, it's not just straight revenue. There's different types of revenue. All right, so I'm going to go over those in a minute, but let's begin every analyzation of the transaction like we do, which is cash changing hands? Yes, we are receiving cash. So we're going to have an increase to cash of $7,500. Whoops, that's too many zeros. There we go. And then we have an increase in revenue. So there are different types of revenue. And depending on the type of revenue is the name of the account that's going to be used when we talk about corporations. So if it's a providing of service, okay, it's going to be fees earned. Okay, that's one type of revenue. If it's sale of merchandise, it's going to be sales. Okay? You are also going to see you might get rent revenue. Somebody's paying you rent. You might see interest revenue if you earned interest. Okay? But remember, revenue has a positive effect or effect, I never know the difference, on stockholders' equity. Okay? So over here, we're going to put fees earned. I can't undo that. N-E. Okay, fees earned. And that is going to be in the amount of $7,500. Okay? So now when we carry our balances down, and some of them, I don't know, I carried the one down and not all of them, so bear with me, but when we carry our balances down, we see in cash we now have $12,500 plus supplies of $13.50 plus land of $20,000. Another zero. Accounts payable is $13.50 plus stock of $25,000 plus a fees earned of $7,500. Okay, so there's our updated balances. All right, moving along. Slide along here. All right. E. On November 30th, 2011, Net Solutions paid the following expenses: wages, rent, utilities, and miscellaneous. Okay, so remember that spending cash or using up other assets in an attempt to earn revenue, these are all called expenses. So these are all expenses, all right? So first question, is cash changing hands? Yes, cash is changing hands. How much cash is changing hands? Well, what you need to do is add up wages, rent, utilities, and miscellaneous. And when you add all that up, you'll see that $36.50 in cash, and that, I apologize, you should already have caught my mistake there, is being subtracted because you're spending that money, right? $36.50. And now we have to include all of these different expenses. So we have wages expense, we have rent expense, I'm abbreviating just for purposes here, space purposes, utilities, and miscellaneous. okay? And then we bring down the amounts. So when we think about expenses, they have a negative impact on stockholders' equity, okay? So we're going to be subtracting 2125, subtracting 800, subtracting 450, subtracting 275. Okay? So when we update our cash balance, we now have 8,850. And then when we update all of these balances, we have 2125, 800, 450, and 275. Okay? And it is in balance because we have 8850 plus 1350 plus 20,000. And over here, we have 1350 plus 25,000 plus 7,500 minus expense. And that will get the equation to balance out if you were to do that math. All right, transaction F. On November 30th, 2011, Net Solutions paid creditors on account $950. So is cash changing hands? Yes. Is it going up or down? It's going down. So we're going to be taking out $950, okay? Because we're making a payment to a creditor, which means we are getting a decrease in our accounts payable, okay? And when we do that and we update our totals, we see we have a balance of $7,900. We have a balance update of $400, and then all the other balances remain the same. Okay, so paying on it, we're making a payment to a creditor. All right, transaction G. On November 30th, Chris Clark determined that the cost of supplies on hand at the end of the period was $550. Therefore, the amount of supplies used amounted to $800. So how do we get there? So first question is cash changing hands? No, it is not here, okay? We're looking at supplies, and right now we say that we have $1,350 in our supplies account. But we know we only, at the end of the month, have $550 there, okay? So if we plug that in over here, we know that we used up $800. That's the difference. That's how we got there, okay? And then it's an additional expense account called supplies expense. This is, if you remember, like prepaid insurance, right? And you have to adjust it out at the end. It's similar to that, supplies used. All right, and last one, transaction H. On November 30th, Net Solutions paid $2,000 to stockholders as dividends. So is cash changing hands? Yes. $2,000 is going out the door. Okay, so that's going to leave us with $5,900, right? So we're going to have another new account here, and that's going to be called dividends. And you know from your Bernie Madoff that dividends are paid out to stockholders. It's a portion of the profits being paid to your stockholders, okay? And they are going to have a negative impact on your stockholders' equity, right? So that's going to be in the amount of $2,000. And so then we have $2,000 over here. Okay, so those are the transactions. So let's look at the summaries here. So, and you guys should be familiar with these. The effect of every transaction is an increase or decrease in one or more of the accounting equation elements. Okay, if they're on the same side of the equation, one's got to be an increase and one's got to be a decrease. Okay, so if we look at the sample here, I believe it was B. They're on the same side of the equation. One is a decrease, one is an increase. When they're on opposite sides of the equation, they're doing the same thing because they have to keep that equation in balance. Okay? So that brings us to the two sides are always equal. All right? This is important. These are the new things as far as stockholders' equity is concerned. So Stockholders' equity is increased by amounts invested by the stockholders. That's capital stock, okay? Those are the owners of the company. It's just like when we used to do transactions for sole proprietorship, when we would say so-and-so invested $20,000 in the name of the business. Okay, that would be an increase to cash and an increase to owner's equity. Now it's just called stockholders' equity. All right? Stockholders' equity is increased by revenues and decreased by expenses. Same thing as owner's equity. It's just called stockholders. And then this is new, the dividends. They're going to decrease the stockholders' equity. All right? Now, last thing. Did I put it in here? Yes. So when we look at the stockholders' equity portion of the equation, these are the parts we see now. We see stockholders' investments, dividends, revenues, and expenses. And remember, the difference between revenues and expenses is going to be your net income or your net loss.